In our strategy, we use a phase framework. We're not here to predict headlines, we're here to track signals, sequencing, and probability. This is a credit signal, not a stock story. When the risky credit complex starts repricing together, it usually matters. Not because it guarantees a crash, but because it changes odds. The central idea is simple. Credit cracks are widening, and the pace is picking up. It's moving from isolated problems into broader doubt. Private credit doesn't trade in a clean, transparent way, so price discovery leaks out through public proxies like BDCs, managers, and adjacent credit products. When those all weaken together, confidence is usually what's getting repriced. It starts as, this is just one messy situation, then a second one appears, then a third, in a different corner. That's when the market stops debating the story and starts questioning the entire portfolio. The common thread isn't rate cuts or rate hikes. It's credit risk perception. It's the question, what did we underwrite, and how certain are the marks, and what happens if liquidity gets tighter? One reason this matters is the overlap in behavior with leveraged loans. We like that as confirmation. When multiple risky credit instruments echo the same stress, the signal quality tends to rise. Here's the mechanism. When confidence falls, liquidity gets thinner. When liquidity gets thinner, redemptions and refinancing become harder. And when refinancing gets harder, restructurings and defaults become more likely, even without a headline crisis. If you want a calm, signal-first lens on macro and credit, you can subscribe to the channel. We focus on what changes the probability map so you can track the cycle without getting pulled around by daily narratives. Think of this as Phase 1 versus Phase 2 pressure. Phase 1 is when the system tries to contain problems with liquidity support and friendly financing. Phase 2 is when something forces selling at distressed prices. We're not assuming Phase 2, but we are watching the pressure build. Redemptions are not a narrative, they're plumbing. If cash needs rise, somebody has to fund it, roll it, or sell something. That's why redemption pressure is a key signal. A quick note, this is educational macro analysis only. It is not financial advice. When you get write-downs tied to real borrower cohorts, it's no longer theoretical. It shifts the conversation from, are there isolated problems, to, are marks and assumptions being repriced across the complex? Another escalation is when the market identifies concentrated exposure, like software lending inside some portfolios. Even if the losses are not yet visible, the uncertainty widens the discount. Then you get the AI build-out angle. Large funding needs can become a credit story fast because the marginal lender sets the terms. If those terms tighten, it doesn't stop the theme, but it can change who can finance it and at what cost. The video also frames Bitcoin as a risk asset proxy. In our strategy terms, it often behaves like liquidity beta, so when risky credit reprices, it wouldn't be surprising to see risk assets echo that shift. We increase the weight of confirmation signals from credit proxies. We stay strict on sequencing, and we treat optionality as valuable when forced liquidity risk is rising. We don't anchor on one ticker, we don't confuse volatility with certainty, and we don't shift regimes without evidence. This is a smoke episode, signals not sirens. We don't need to be early, we just can't afford to ignore the confirmation when it arrives.